Welcome, everybody. This will be the fourth installment of Coffee with Carl. Today, I have the pleasure of John Ognar from Wells Fargo Global Asset Management. He's on the special global equities team. He also formerly worked with Citigroup and Guggenheim Partners. John, welcome.
Thanks, Carl. Glad to be here. Appreciate it.
Today, we're going to go through and just talk a little bit about the market and get Wells Fargo and your opinions on where we're going. And what expectation you guys have between now and the end of the year.
Okay. Yeah, it's been a crazy 2020. I mean, it's hard to believe what we've lived through in just 9 short months here. If you think about it kind of on an academic stance, we've lived through 2 different standard deviation events, and I call them probably two standard deviation events, with the drawdown we saw in the first quarter and then the sharp rally back in the second quarter and what we've seen to date in the third quarter. Pretty amazing, just to see that much volatility in 1 year. I think in the first quarter, the fear trade caused spiking correlation within stocks. Mm-hmm. And for us as active managers, that's a buying opportunity. Yep. So we were very active in our small and MidCap Value portfolios, kind of taking advantage of, pardon the cliche, but good companies getting thrown out with the bathwater as correlations spiked. Then in the second quarter, as we saw that kind of beta rally off the bottom, we were a little less active, mm-hmm. kind of letting those factors drive stocks. It was very much a macro-driven market, and we kind of wait and watch from the sidelines there, waiting for those buying opportunities to present themselves again. Being long-term investors, I think from an economic standpoint, we are seeing some recovery within the individual sectors and within the economy. Part of that is driven by monetary fiscal stimulus and some of the actions that we've seen there. There has been kind of a backstop provided to a lot of the companies needing further liquidity, further capital. Unfortunately, that makes it a little bit harder for price discovery to actually happen, as some weaker fundamental companies are held up by some of that easy money that is being absorbed within the capital markets. But over the long term, we do think things are getting more constructive. Obviously, we have to keep our eyes on the election. We have to keep our eyes on what happens with the virus and further economic shutdowns. But from a lowered expectation standpoint, we are seeing signs of economic recovery across the globe, really.
If we were looking at more from the short-term cycle between now and the end of the year, do you see more on the headwind side or more on the tailwind side?
It's probably more on the tailwind side once we get through kind of November. I think once companies start to get some transparency on what the regime in Washington is going to look like, and it's not so much a call on who's going to win, but rather they just need that transparency to say, okay, here's the new regime, here's what we're dealing with from a tax policy, from a regulation standpoint, and then they can start their strategic planning. Now, obviously, the wild card is the virus. If we did see a major spike as far as a second wave, and we saw a complete economic shutdown, then concern and headwinds definitely return to the market, but that's a little bit more unpredictable. So I do think, we're seeing kind of industrial materials, kind of that old world economy stocks start to gather off the bottom, and they're starting to see improved fundamentals. So hopefully there's stronger tailwinds from an economic standpoint going forward.
Yeah, it seems to be. I mean, with this, we've really rocketed from the bottom. And then every other day you're hearing a number of analysts starting to get a little more cautious, some of the different hedge funds as well. But it also seems to be the market just continues to ignore any negative highlights. I mean, you're starting to see the virus spike a little bit in Asia and throughout Europe. Do you guys expect there going to be a point where we actually take that news into account, or is it purely going to be just, hey, we have a success on the virus side from a vaccine potential, so keep piling ahead?
Yeah, I mean, I think it's probably the market is discounting every good news thing it can get its hands on into stocks, and definitely seems to want to go higher. Yeah, I mean, I think it's going to take a lot to stop that euphoria feeling. Now, hopefully, there's a return back towards fundamentals, and it's just not these, beta factors and
Yeah.
and higher leverage companies, higher momentum companies kind of winning. We'd like to see, true good fundamental stories actually outperforming. But I think that will quiet down as we can get some confidence around the economy and hopefully vaccines. But there certainly could be ripples to that path, but for the most part, there definitely seems to be an undercurrent to want to take this market higher. You look at the biggest winners within the S&P 500 and obviously the FANG stocks and the NASDAQ stocks have been those biggest winners. I think as you get more confidence around kind of an economic turn, then you'll see some of that these value rallies that keep getting stalled out start to have some legs, and those more cyclical companies will kind of be the leadership for a while, and some of that large cap tech leadership will start to wane.
I think that brings up a good point. When we talk about the small cap space, for example, obviously it's lagged, pretty heavily the rest of the market. Is that one of the areas that you guys see to have the greatest opportunity once we have a vaccine? And where, overall in the landscape of the entire market, where do you think there is the most opportunity?
Absolutely, yeah. I think when you look back over the last 30, 40 years, there's historically been a small cap premium. You're taking higher standard deviation risk typically with small cap stocks, small cap cash flows. So you demand a higher premium for that. And with that usually comes higher returns. Over the last 3 to 4 years, we haven't seen that premium. But when you look at charts of past recessions, the 2008, 2009 recession, 2001 tech bubble led US recession, what you typically see is a defensive rally before that, where large cap outperforms small cap, growth outperforms value. And we like to use the analogy of, think of it like a tsunami, right? The animals and the little critters all know when a tsunami is about to hit, they run up the mountain and flee for higher ground. That's exactly what investors have been doing, here around the coronavirus and the recession that's caused. We saw that exact same thing happen in 08 and 09 and then 2000, 2001. But as we get through that recession and we start to see the market discount on economic recovery, you see small cap stocks, you see value stocks inflect, and you see that small cap premium return for sure. And there's really quite a big bounce for small caps. Timing that event is always difficult. A lot of investors wait for the fundamentals to turn, but the market will discount that well ahead of the fundamentals turning as soon as they get any type of transparency, visibility on that economic turn. So I think now is actually a very good time for people to kind of be rebalancing some of those large cap winnings that they've had over the last few years back into small and mid cap, because you will get that bounce once the economy turns.
When we're talking about the small cap, would you be looking to sell some of the winners more so towards the tech side? Or, I know when you get into the value space, there was a lot of stuff when Buffett sold out of the airlines, so the big concern there. But recently we've had a rally in the retail and that space. So where would you look to reallocate some of that money towards a small cap space?
Yeah, it's a little tougher for us value investors that don't have technology making up huge percentages of our indexes. I mean, even when you look at the Russell 1000 versus the Russell 2000, tech has dominated the large cap Russell 1000, and then that's propelled a lot of that outperformance. Down in small and mid cap, you've got, especially on the value side, you've got financials, you've got industrials, materials, energy, again, some of that old world economic cyclicality. But we do think that is a good area to look towards, for that economic exposure, that cyclical exposure and recovery. So what we focused on within our small cap portfolio, industrials and materials. And when I say industrials and materials, I don't mean your most commoditized chemical company or your most commoditized machinery company. We're looking for companies that make widgets or solutions that no one else makes and their customers can't live without. They harness pretty sustainable free cash flow from that. That free cash flow back in their balance sheets, and they can use that that balance sheet flexibility to kind of control their destiny as they deploy capital. And so we would rather get our economic sensitivity from those high quality industrials and materials names versus your more commoditized chemicals names or even commoditized banks. When you're buying banks, unfortunately, you're making a call on the yield curve, you're making a call on interest rates, two things that we don't think we're necessarily great at, we don't think investors are great at, and we definitely don't think CEOs of banks have any control over. So we'd rather take that cyclical offensive capital and put it into high quality industrials names. One area within MidCap that we found some good opportunities is in healthcare. And I'm not talking like pipeline biotech or pharma stocks, because those are typically event related stocks. What we're looking at is kind of stocks that have good fundamentals, but have been hurt due to their exposure from elective procedures. Unfortunately, during the pandemic, a lot of companies, you think of a Zimmer Biomet in the hips and knees replacement space, and Alcon in the ophthalmology space. These stocks have sold off because they've, on a short-term basis, they've had to defer a lot of their cash flows, a lot of their earnings, as those elective procedures aren't getting done. But eventually, people are going to have to get those hip and knee replacements. They're going to have to get their ophthalmology surgeries done. They just can't put them off any longer. And that should benefit these stocks over the next 3 to 5 years. So we've been kind of leaning into that weaker fundamentals on a short-term basis because we're pretty optimistic about the longer-term opportunities there.
That makes sense. Now, when we talk about, I mean, one big thing we hear a lot about is the kind of Robinhood trade pushing in and driving up some of the valuations. I mean, now Apple has one of the highest valuations it's ever had, Tesla, and then Nike is another big example. At any point, should we really start to be concerned about these valuations? Because if you have these big tech names sell off and have the reversion to the mean, they're going to pull back because they're such a big component of the S&P. They're going to pull back the entire market. So I know I have some clients that are really starting to get concerned about a potential sell-off. What would you say to them, in the near term, or would it be more along the lines of just, even if there is, just kind of stick it out because we feel really comfortable about the prospects in the future?
Yeah, it's a good question. And unfortunately, we're in this situation where a few names are kind of driving the boat. And given the S&P is dominated passive flows and it's a market cap weighted index, so the bigger just keep getting bigger. And those handful of large cap technology stocks just continue to drive the market. We don't focus in that area as much. I can't comment on are they overvalued or not, but you certainly are at risk for a pullback within those stocks. Just any single stock risk, you're going to see that. But to the second part of your question, I think that provides a good opportunity for the rest of the market. Because I don't think that money necessarily flees equities. I think it finds a home within other areas of the market that maybe have more attractive valuations and improving fundamentals to justify those valuations. So I think we're pretty optimistic that if you did see a shakeout in some of the FANG stocks, the Teslas of the world, and that Robinhood push would actually create a nice buying opportunity for the rest of the market and could propel the fundamentals over the next few years for small and mid-cap stocks for sure.
When it comes to small mid-cap space, obviously what your guys' specialty is, are you guys taking into account any ESG mandates and thought processes with the companies that you guys are looking at now? I know that's become certainly a big push with the overall markets and investing.
It is definitely an evolving space, and it's evolving within our process. So we run 4 strategies: our U.S. special small cap, U.S. special mid-cap value strategies, but we also manage a global small cap and an international small cap strategy. The demand on the global and international side of things is huge. They seem to be, the investor base there seems to be a little bit ahead of the curve on ESG as far as making it a priority, but we're definitely seeing that trend. What we've tried to do is say, okay, let's look at our process and see where ESG has played a part and how can we communicate that better. Our focus is really looking at companies capital deployment opportunities and how they can use their balance sheets to control their destiny. With that, obviously, comes strong governance, because we're looking for management teams that are trying to create good shareholder value from that capital deployment. But we also spend a lot of time kind of calculating downside risk for each one of our names. And with that, ESG is very focused on these different scenarios that could happen in a downside risk environment. And when you think of environmental liabilities, when you think of social, right to earn a living wage, and as companies cut costs during the downturn, how are they treating their employees, and how are they going to be positioned for that future upturn? The social aspect is something that we focused on too. And so in our process, what we've tried to do is really just highlight where those E, S, and G risks are, and where we're being paid to take those risks, where we think they're effectively captured within some of the third-party ESG providers like a Sustainalytics or an MSCI, which tend to be a little bit more backward-looking. They tend to be a little bit more large-cap focused, but with that creates some inefficiency for us to take advantage of, because we're talking to these management teams every day. We can address these ESG concerns and get responses and engage with the management teams. And so I wouldn't say it's the driver of our process at this point, but we're really evolving the process to do a better job of quantifying those risks, looking for opportunities that we can exploit within that ESG space, and then, kind of communicating that better to our investors.
When we're talking about volatility, to the point earlier about having more risk and looking for a risk premium in the small cap space, what are you guys doing to manage volatility? If we start to see that spike, during the election and, into the future, whether it be China or whatever it may be, how do you guys try to position for that?
Yeah, it's one of the things that allows us to sleep every night, is that our process tends to do a really good job of kind of protecting capital in down markets, and why it's our funds have been kind of the investment of choice within the defined contribution markets, because it does show that good downside protection. We get that downside protection from our stock selection.
Yep.
It's not from hiding in utilities and REITs and staples and some of those defensive areas, because that's a timing call and very difficult to do. And again, you're trying to speculate on interest rates and other variables that are very difficult to predict. So the way we play defense is just by looking for companies that have incredible flexibility in their balance sheets. So not just low amounts of leverage. We want to look at how those balance sheets are structured from a maturity profile, from a vehicle, from a covenants, really understanding how much flexibility is in there to weather a particular downturn. And then again, they can play offense when all their competitors are forced to play defense by deploying that capital at the right point of the cycle, when they start to get that transparency into an improving economic picture from the election, et cetera. They can deploy that capital, pounce on the opportunity, and they're that much better positioned for that eventual upturn. We also look for companies that have sustainable free cash flow. So kind of recurring revenue, recurring cash flow streams, because that's kind of the gasoline to our balance sheet engine. We want to make sure that we never run out of gas, even through cyclical downturns, that cash flow is continuously getting pumped back in that balance sheet. And so by focusing on those two things, flexible balance sheet, sustainable free cash flow, it tends to provide very, very good defense through downturns. We saw it with the drawdown in the first quarter, and then we can kind of take advantage of that opportunity, deploy capital through the downturn, and then it should allow us to play offense then through the upturn as well.
In the next year, yeah. We briefly highlighted the global international space. What are you guys seeing as far as opportunity in the international when we're looking at countries? I mean, is there any obviously there's a lot of talk about China has been a big driver, China tech. Where do you see opportunities maybe in China? And then are there any countries around the world that you guys are really highlighting as could be global leaders into the future from a market perspective?
Yeah, it's interesting. So we're developed market only. We don't play emerging markets, but obviously China has implications around the developed markets for sure. So you have to understand what is happening within China and the trade situation. It's been interesting, just this year when you look at the different countries, the different regions, and the performance and the correlation to how are they surviving the virus? What are the infection rates and the recovery rates with the virus? And then two, how are they handling shutdowns? And so you see some of the Nordic countries like Sweden that didn't shut down and their economies kind of kept trucking through, have been some of the best performers. And you see other areas of the globe, like whether it's Australia, New Zealand, that have done a good job, Canada even have done a good job containing the virus, have outperformed.
Mm-hmm.
And so that trend we expect to continue here as we go through the volatility. Japan, for example, did a really good job of containing the virus in the first quarter. Plus, they had the Olympic tailwind still expected to happen in the first quarter. That all kind of fell off in the second quarter, and you saw virus rates spike, and obviously the Olympics were delayed. And those countries and the performance of those countries have kind of followed that. From an opportunity perspective, I think we're feeling like areas of the UK and Europe, probably more Northern Europe, have good opportunities as far as recovering from basically an industrial recession that they've been in over the last few years. And as you get that economic bounce that we were talking about earlier, you're probably going to feel it first and strongest within some of those geographies. So, that's an area that we've increased our exposure to, and we're seeing more attractive valuations from a bottom-up standpoint. It'll be interesting to see how these different economies open up and how they handle reopenings. But I think we're feeling like Japan, areas within Australia or Asia, Australia, and then Europe probably lead us out of this. And that's probably where the most interesting opportunities are right now.
Any specific sectors that you guys are looking at over there?
Yeah, continue to kind of overweight things within the industrials and materials space.
Mm-hmm.
Similar to my comments earlier on the U.S. small and mid-cap space, when we're looking for that cyclical exposure, kind of the offensive part of our portfolio, much prefer to get that from the industrials and materials versus banking or financial stocks, again, that are more of a call on interest rates and the yield curve. Consumer staples fit our process extremely well, where you get that consistency of cash flow, and they can pour it back in the balance sheet and then kind of take advantage of the market opportunity by deploying that balance sheet. So continue to kind of overweight that area within consumer staples. And then, technology is an area that we've been looking and shopping in. I think when you initially saw those correlations spike, and again, you saw those higher quality companies thrown out with the bathwater, you saw a good opportunity to buy some of these technology names that have always looked expensive to us. When we're playing technology, again, we're looking more for that reoccurring cash flow stream that you typically find with a services model, kind of a fintech type companies, and less so from that more cyclical semiconductor exposure, which can be, again, more of a timing call. We're looking for kind of those reoccurring cash flow streams that we know are going to be there quarter after quarter, year after year.
Do you guys have, I'm jumping around here a little bit, but do you guys have, on Thursday, Jerome Powell was to make a fundamental and profound speech. Do you guys have any thoughts on that? And obviously interest rate or inflation is being brought up, but it doesn't seem like that's going to go anywhere anytime soon. So, you guys have any thoughts on that? And then pending that, how would you be positioning, your guys' space to combat that?
Yeah, it's interesting. And, I'm getting a ton of questions on the whole growth versus value conversation. And it really comes down to inflation, interest rates, and GDP growth. And obviously all three are tied together. But when you think of this 2009 to now recovery, we've been in a pretty mundane GDP growth environment, kind of less than 2% GDP annualized growth, very mundane inflation, as you mentioned, and interest rates have been kind of on this steady path down because there hasn't been any inflation to combat. Yeah. I think Powell and the Fed would like to, continue to kind of keep some dry powder to fight any potential inflation that comes, but they haven't seen it yet. Now, I know just this morning, our retail consumer analyst was mentioning that you were seeing some shipping tightness and some surcharges that those companies are expecting around holiday shipping already. That's typically where you start to see inflation start. When you start to see supply and demand dynamics really tighten within kind of those shipping and back quarter areas, then it leaks into higher pricing for the consumer, and then that's where inflation begins to spike. We're at the very early stage of that, so I don't think inflation is a major concern at this point. But you also have a 10-year yield here that's kind of at historic lows. And you have to take the view, how much lower can it go and how much longer can it stay at these levels?
Yeah.
If you see inflation, if you did see interest rates move higher and you saw GDP growth maybe even touch 3% again, I think it sets up really well for that small and mid-cap value area that we were talking about earlier, just because that's going to give you the most leverage towards an improving economic picture. I'm not making the call that we're there yet, but I think when it happens and the market starts to discount it, the move's going to be very, very swift, and that's probably the best area to get exposure to that.
Yeah, I mean, how does you think about interest rates? I mean, how do internationally we're talking negative rates? I mean,
Yeah.
how do is that going to continue forever, or how do we get back to because if you start to normalize those, I would imagine that you guys would have to make some shifts within your international portfolios too to combat that.
Yeah, it's amazing. We've said for years, investors have said for years that this can't last long, and things like Japan with negative rates and now Europe, that can't persist, but it has persisted for a long time. And when you look at the Japanese equity market, it's been the second best performing market over the last decade, second only to the U.S. Despite having negative interest rates, and I think those companies that are able to take advantage of that environment, and not necessarily lever up unwisely, but just take advantage of the interest rates available to them and deploy that capital, are going to be winners over the long term. We're starting to see that within Europe as well, where you're seeing some European companies or even U.S. companies that have operations in Europe finance debt with very low negative interest rates, basically within those local geographies, and make acquisitions here in the U.S. or elsewhere. And it's a great use of capital and a great offensive move that they can do to better position themselves. And so from a bottoms up standpoint, we'd like to see companies take advantage of that. Again, the sustainability of those low interest rates is going to be a little bit tougher to call, but probably going to take some while to work its way through the system and recover.
No, that makes sense. I guess my final one, if you were to pick, growth versus value, when we're talking the small cap space and small mid, where would you be leaning more towards? If we're saying the next, let's say, looking, now obviously in the short term call, it's impossible, but maybe say we look to the next 1 to 2 years.
Yeah, I think, obviously we have a little bit of bias being value managers, but we're not deep contrarian cyclical, value managers. We tend to have that sustainable free cash flow bias that puts us a little bit more on the right-hand side of the value box. But to have to make that call, I would say, over the short term, 6 to 12 months, growth probably could continue to win here, just given the uncertainty, and in that uncertainty around the environment, around the vaccine, potential vaccine, the virus, people tend to look for those idiosyncratic growth drivers that growth companies tend to possess. But then, if we wake up tomorrow and there's a vaccine, or we get further visibility, improved transparency around the economy, then you're going to see that cyclical value trade work. And again, it's hard to time that. So I think over a 18-month to 2-year window, I'd be leaning more towards that value, just because you're eventually going to get that recovery. And when you look at the valuation spreads between growth and value, we're obviously at all-time highs. And I'm not saying growth doesn't deserve to trade at that premium, but eventually you're going to see that that kind of return to normalization, that reversion to the mean type of trade happen once you get that improved transparency on the economy, and that's when you're going to want to have that small mid-cap value exposure for sure.
No, I think that's really helpful, because my goal is just to give clients and individuals a better understanding of where the opportunities may home. So as a takeaway, on the value side, you guys are really liking the industrials and material space. Any other ones that you would recommend that clients should be looking at from a sector standpoint?
Yeah, I mean, I think healthcare, again, some of those names that have been beaten up just because of their exposure to elective procedures when, their cash flows a quarter out might be impacted, but when you look at them 3 to 5 years out, there's very manageable or minimal impact to that. But there's some good opportunities there. Within consumer staples, again, we love the sustainability of those cash flows. Consumer discretionary has been a little bit more volatile to play, especially when the travel exposed names, the leisure exposed names, the retail business model is changing in front of our eyes. There's going to be winners, there's going to be losers. So there's opportunities there, but there's also a lot of risk within that business model. And those companies that don't have the balance sheets and the cash flow stability to weather that volatility and reinvest in their online technology, and they're going to face some really strong headwinds. So for us, as active managers, there's some opportunities that we can kind of pick through, but it's an area to also be concerned about. And we've seen a rally off the bottom in a lot of those stocks, but it's also a lot of volatility still ahead as those business models evolve.
That makes a lot of sense, and I think that lays a good framework just from a thought process standpoint. But thank you, John. I appreciate the time today. It was really, really helpful.
Absolutely. Thank you, Carl, and appreciate all the support. And if further questions come up for any of your clients, feel free to reach out to us.
Yeah, and as a takeaway, his team manages small and mid-cap value over at Wells Fargo. It's been a top performer, and certainly something we recommend to take a look at, for our practice as well. So thank you, John, and hope everyone enjoyed listening in. Thanks today.
All right. Thanks, Carl. Thanks, everyone.
Take care.